Overnight, Fed Reserve Chairman Ben Bernanke telling lawmakers on the Hill that the $600 billion stimulus that's been put into the system from the Fed could in fact create more than 700,000 jobs inside 2 years. Now, he's made those comments at a private meeting with members of the Senate Banking Committee, citing research done by the Federal Reserve Bank of Boston. Let's take you to Larry Shover from Efficient Capital Management. He's author of Trading Options in Turbulent Markets, and he's standing by at the CME in Chicago. Warm welcome to you. That link between 600 bill and 700,000 jobs, do you get it?
I hope it happens. It's one of those things where I hope he is right. There's a lot of history to prove that he will be right, but we're just grabbing at straws right now. This whole market is just in a quandary, if you would. This whole week, there's a lot of tremors going on. We had a little bit of a reprieve today. The market, the S&Ps were up a couple dollars here towards the close here on Wednesday. But the fact remains, after yesterday's drubbing, being up $2 in the S&Ps is surely a welcome relief. But the market right now, all of a sudden, is shifting back to fundamentals. All the problems that are going on in Ireland right now. Think about in Greece, where the European community has come together and said, we're not going to provide more bailout if these guys don't get their act together. A lot of things swirling around, a lot of moving parts. Yeah. The market now is all of a sudden back to fundamentals, and you can see it today.
I just want to know, though, Larry, but accepting all of what you've just said, if Bernanke can be that clear on job creation, why has it taken that many months to come out with QE2? If he can say today that we're going to see 700,000 jobs, why did he not do this 12, 18 months ago?
Oh, that's a great question. I mean, who knows? I think they were waiting to see if the initial quantitative easing was even going to be effective. And it looks like the market was calling for QE2. And keep in mind, we're in the dark right now. Bernanke, people have a lot of hope in him and what they're trying to do. But the fact is, we're in uncharted territory right now. I mean, he could say it's going to create 2.5 million jobs. I mean, what does it matter?
Well, it kind of does matter because Obama just lost his chief jobs advisor in the latest clear out. Now, if that advisor put her hands up and said, sorry, I can't square it, does Bernanke walk the plank as well if he gets it wrong?
Oh, he's going to have to walk the plank. I mean, that's a bold statement to come out and say, we think this is going to create 700,000 jobs. I hope he is right, and America hopes he's right, because right now we're 9.6 unemployment rate, much higher than Australia. Things need to get moving here in the United States.
Well, things moved on the dollar front overnight and kind of brought back into play some appetite for commodities. Tell me about crude. What have you been watching there? Have you been interested in those moves?
Yeah, crude, even though the inventory report didn't come out very well, crude actually did act strongly in the opening. At the close, it was off just a little bit. But what's going on right now is like a mixed bag of nuts with all the commodities. You have gold and copper a little bit lower. You have all the agriculture is lower. And they're all saying it's due to the weak CPI number that came out this morning. That's one person's opinion. I'm not sure if it's right. But in the bigger picture, the dollar is going back to where it was. The Australian dollar and all the other currencies are continuing to rally. The Aussie closed around 98, and the future is much lower than where it's been even like 3 weeks ago. But the dollar lower, treasuries higher. That seems to be the bet right now.
And tell me about rollover as well. This idea that at this point in time, you've got to continue either with an existing contract, roll that one over, or liquidate your position. It seems that the bias is towards the latter, just because of the time of year we're at and the need for clients to kind of rule a line under what's been a pretty good year.
Yeah, absolutely. And except for the equity markets, it seems like a lot of people are liquidating. There seems to be a lot of hedge fund liquidation because we are in such uncharted territories. We've had such a nice run, a phenomenal run actually since May. And except for the equity markets, especially in gold and in crude and in the ags, it seems like people are more tend to liquidate their contracts right now and wait to see what happens in the next 2 to 3 months. You can see the hedge fund statistics in the United States. Hedge funds are well underfunded right now. They're not putting money out. They can't produce returns. It's just too risky right now.
Larry, Tony Rumble from Alpha Investments. GM comes back to the boards tomorrow. That's got to be a bullish sentiment back into the market with that recovery now, you know, really being seen to work.
Boy, we're really divided on that. Some people think it's going to work very effectively. Others say it won't. I think that's why the options contracts, if you look at the implied volatility, the price people are willing to pay for options is very, very high in long-term options. In short-term options, it's actually kind of short. It's kind of slight. There seems to be a lot of uncertainty. People are willing to say, okay, right now, the next couple of weeks, couple of months, things will be okay. But people are very uncertain, more uncertain than they've ever been, actually, in a long term, in a 12-month options.
What's that reflecting, though? I mean, is it uncertainty about QE2? Is it uncertainty about Obama's re-election? If you're saying short-term vol is low, but higher volatility at the long end, that's really interesting.
It's very interesting, and it's more peculiar now than it has been in a long time. If you look at like the 12-month options in the S&P contract here traded at the Merc, those options are implying a 1.4% move per day. Now, we got that move yesterday, but that's not typical. The front month of the curve, the first 3-month option contracts are pricing in well below that. In fact, yesterday's move, when we were down like 1.6%, the options contracts were implying less than 0.75% move. I think it's one of those things where people are highly uncertain of what's going to happen in the future because of Asia, because of Greece, because of Ireland, and because of we just keep devaluing the dollar at will, hoping that it's going to create jobs. So far, it hasn't done a thing. People are smart enough to recognize that these things won't happen. We won't see the results of that for about 3 months.
And are people smart enough, though, to look at that Asian session briefly and to see the jitters and believe that the lack of volume in those markets as well probably is telling of it in itself? And don't get too frightened by sharp moves in markets like the composite, because actually people are taking a back seat to those positions as well. It's interesting, Larry. We're going to have to actually leave you before we get an answer on that one, but we'll talk next time. Thank you so much. Appreciate it.